Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to our viewers from across the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me on this Friday morning, live at the New York Stock Exchange, is Tai Wong, independent proprietary trader. Tai, happy Friday.
Good morning.
Good morning. What a week it's been.
What a week it's been. The UN is wrapping up here in New York. It's been a big week for China, and it's World Tourism Day. So, I guess tourism is good. It gets people, different countries to mix with each other, to see each other as people. So it's a good thing, tourism. I like tourism.
Absolutely. And speaking of tourism, let's start out by looking at where markets are right now.
Yes.
Because on this Friday morning, on the heels of the latest U.S. economic data, we saw PCE, which is the Fed Reserve preferred gauge for inflation, coming cooler than expected. And we saw straight out of the gate the Dow Jones Industrial Average soar. And right now at this 11 o'clock hour, we are seeing the Dow Jones Industrial Average up by triple digits, or nearly 0.9%, and that is significant. But meanwhile, we're seeing the Nasdaq Composite Index nearly flat on the session after opening higher, and the S&P 500 is extending gains higher by 0.2%, and this does come after a record high yesterday. So what a way to kick off today's session before we head into the weekend.
Yeah. This is the PCE, core PCE is the Fed's preferred gauge of inflation, or at least this Fed. Someday it'll be a different gauge, but right now it's this gauge. And month on month, it was only up a tenth. The consensus was 0.2, and year on year, which typically month on month, I like it better because it's more recent, but Chair Powell has said we like to look at changes over time because it does take some time and for things to get through, and we don't want to react to a month. So year on year, it was 2.7%, which is still on consensus and still above where the Fed wants it to be. But I think this report will make them pretty comfortable about inflation. So the futures moved a little bit more towards 50 basis points versus 25 at the November meeting. It's still around 55, 45. So I think the market still isn't sure. But what this says is the Fed can really just pay attention to employment. That's what they're worried about. They don't want employment to get any worse. But inflation seems pretty well behaved. 2.7 over time, probably a little bit too high, but that's, I think that's really on the back burner right now.
And you bring up an important point because jobless claims figures yesterday, we saw a decline in both initial jobless claims as well as continuing claims. And of course, next Friday, we get the big jobs report for the latest month, non-farm payrolls, unemployment. But we don't have a Fed Reserve gathering meeting or rate announcement in October. The next gathering and meeting will take place after the election on November 7th. So we do have some time to assess what the economic situation is here in the U.S.
Yeah, so I think the employment report's really important. We also get JOLTS next week, which is job openings, which is, again, something that Jay Powell says, we watch. And that has gone from having 2 jobs per person looking for work, about a year ago to about 1.1 or 1.2 now. So it's imbalanced. They don't want it to get any worse. But this employment report will be important because it'll be one of the, I think they will actually see one more employment report before the next meeting. I'll have to check on that, but they want to see how healthy employment is, and just so they know whether they want to go 50 or 25. But Jay Powell has a speech next week as well, and the market will pay attention to see if he's dropping any clues. But we're still pretty far away from the next meeting. So as we get closer to the meeting, that data will move the markets more. Right now, it has an impact, but a little less.
And you mentioned what we have coming down the pike next week. So next week does mark the beginning of the month of October. We still have one more trading session for September before the third quarter wraps up. But a lot is on the calendar next week, in addition to jobs report, Fed minutes, as well as Fed officials. We've been hearing from plenty of them this week, so it's very interesting to hear their consensus, especially when hearing from Bauman, the one dissenter from the latest meeting.
Right, very much so. So this is the time for the Fed to come out and talk about things. But they have a lot of time until the next one, which is important. And what's also important is we mentioned that October 1st we have the last, the vice presidential debate, and this election looks like it's really going to come down to the wire. all the focus is on the on the half a dozen or so swing states. So that could matter if there is, I think, a a specific a big change or something unexpected happens, and one vice president or candidate does a lot better than the other one, could move the needle a little bit, and that little bit might matter. Because if you remember, the popular vote differential might be 3%, but in the last election, if you moved about 75,000 votes the right way in the specific counties in each state, that would have changed the election. So we're talking about potentially 50 to 100,000 votes in the right states that could flip the election. So this will be very closely watched.
I'm sure you and I will be talking about it on Wednesday morning after the VP debate on Tuesday evening, 9 p.m. Eastern Time here in the U.S. And of course, we'll be taking a look at the election and some of the issues later on in today's segment. But before we get to that, I do want to talk about Costco. So they reported their earnings yesterday. We heard from executives in the earnings call. And because you mentioned October 1st, we'll have to wait and see whether a strike with the workers, dock workers, and the longshoremen group will be reached or not, because they addressed that yesterday in the earnings call for Costco, saying that they had been anticipating supply chain disruption ahead of the holiday season. So
it doesn't look like they will settle this strike. I don't know how long it will take, but it has been well telegraphed. So hopefully, everybody who needs materials that comes through the East Coast have already gotten it or are figuring out ways to do it. There will be an impact. I mean, it's $3 billion of stuff going through these ports every day, so it's hard not to have an impact. But we look at Costco this morning, they'll say it's down substantially, 1.5%, despite having a very good earnings report. The report said they were getting more foot traffic, so people were spending a little bit less per visit than they had before. But I think what it says is Costco has gone up 37% this year. So I think the valuation there is a little stretched. Costco is a great company. We love it. I mean, I love it. But they don't grow. They can't really grow that dramatically because they really only, their margins are 11 to 15%. And a lot of the money they make is actually from memberships as well. So valuation's a little stretched there. I don't think it's going to collapse, but when you go down on a good earnings report, suggests that we may need some more consolidation or maybe a little pullback here before it rises. And it's a good time to talk about the overall stock market, which feels like with the Fed cut and the big boom out of China this week, and they added to it in the past day, where they cut the 7-day reverse repo rate from 20 basis points to 1.5 to 1.7. So that's the last strike for the monetary policy folks for now. But that's really those two things have really, I think, made equity investors very, very comfortable that we're going to have a grind up higher. And the other thing I saw this morning was Bloomberg reported that U.S. holdings of ETFs have now hit $10 trillion. 10 trillion, that's a big, big number. Just for, so you can compare, it was only 1 trillion 14 years ago. And at $10 trillion, if you figure about 35 basis points on average for fees, that's $35 billion in fees that U.S. managers of ETFs are taking in.
Not too shabby.
Not too shabby. But one of the reasons why people do actively managed mutual funds and sort of actively managed hedge funds, sometimes really struggle, because it really having ETFs where the average citizen can easily invest in almost anything. So if I wanted to invest, and I do, in the 10-year bonds, it's a little tough to buy 10-year bonds, but I can buy the ETF UTEN. It's basically the 10-year bond ETF. So really easy for me to manage. I don't have to worry about taxes because it's all in my Schwab statement. It's really amazing, and I think that's why all the flows are going in there, and you could see stocks just grind higher for the balance of the year.
And given that we're about to wrap up the third quarter, it'll be interesting to see the total amount in terms of U.S. ETFs as well as global ETFs, and what regions are seeing the most growth when it comes to these types of funds.
That's absolutely right. I mean, the idea of the flow that comes in, especially to Vanguard, the S&P 500, which started, I mean, these ETFs started in 1993. They really didn't get popular until probably around the year 2000. Um, you know, all the money that comes in, remember August 5th, that major collapse, the market bought the dip. So it's really hard to fight against that market. I think it's almost $700 billion have gone into ETFs already this year, and a lot of that is in the indexes.
And because you mentioned what we saw from Asia this week, I do want to shift our focus on over to Japan. So if we look at the FX markets, you and I talked about it.
Right.
We saw the yen rally strengthen over 1%. So this is very interesting because we were talking about the ramifications of the results for the LDP heading into this weekend. And both of us woke up, we looked at our phones, and we saw that yen gain, and we're like, oh, I wonder what happened. So what do you make of the implications for this?
You know, late last night, at New York time, dollar yen was, I think, might have gotten up to 146. I want to say. What was the high dollar? Yeah, dollar yen high was 146.50 late last night, and I think the feeling was, and it was specifically that sitting Prime Minister Kishida, I think, group was going to vote for Sane Takeichi, who's the Abe acolyte, who's sort of very kind of a hawk, but wants to keep interest rates really low. And the feeling was she would really lean on the Bank of Japan not to raise rates anymore. So she was she wasn't the favorite at the beginning of the week, but she sort of became the favorite towards the end. And that's why people were selling yen, buying dollar yen, because if the BOJ doesn't hike, then the carry trade will have more legs under it. So when we woke up this morning, it was a 142. I'm like, she must have lost. So indeed she did. She lost to a former defense minister, kind of an outsider. Remind me of the name. I can't remember the Japanese name.
His name is Shigeru Ishiba.
Ishiba, right. So he's been sort of an outsider, and but he's in terms of humble. Wants to have an Asian NATO, which the Americans have said, well, maybe not a NATO, just a sort of security arrangements, because the idea of an Asian NATO probably makes the Chinese angry and nervous, although nobody's going to invade China. Last time it happened, it didn't go well for anybody. So nobody's invading China, but NATO, and then having sort of a combination where an arrangement where everybody has to come to the aid of somebody else might make people nervous. But anyway, he's considered an outsider, but he wants to continue with how the Japanese economy is going, and he's probably not going to lean on the Bank of Japan. So that was a big move in dollar yen, which was quite remarkable. So I guess that election was really close, though maybe not as earth-shattering as the as the U.S. election, unless you're trading dollar yen.
Absolutely. And Tai, before we move away from Asia, I know that we had some charts prepared when it comes to China.
Absolutely.
So let's do a brief review of China. So the major injection of stimulus from China's central bank, we saw it shore up the equity markets.
Absolutely.
And when it comes to that market, we know that they are about to head into a holiday next week. So let's start out by looking at
graphic
the chart.
So this is the benchmark Shanghai index this week. Look at those bars. I mean, they've essentially erased all the losses for this year inside of a week. And it was sort of, they started on Tuesday. You saw the Tuesday bar. And then Wednesday, and then I think there was a little, actually Wednesday I think was the quiet one, then erupted Thursday, and then finished the week really strong. Appaloosa Fund Management's David Tepper said, I am buying anything with China attached to it. And I have some guardrails in China, he said, but he said, I'm actually going to take some of those guardrails off, because he's really excited about China. So when you see a chart like this, you do not want to get in front of it. You do not want to fade it. Whether or not you believe that all the things that the Chinese have done so far will really turn that economy around, I think that's up for debate. What's not up for debate is, I think all the monetary stimulus is going to be good for markets. As a matter of fact, People's Bank of China can't legally buy stocks, but they've said we put up a lending facility where you can borrow money and buy stocks, like banks or insurance companies. So functionally, they're buying stocks. So I think the trade here, if there's a dip or a consolidation, you may want to put a little money in here. So let's go to graphic number 2. So just for so we can see, taking a step back, this is a 5-year chart, and at the far right-hand side is what's moved so far this week. So each bar is a weekly chart. So you can see that it's gone up a lot this week, but valuations are still quite low given where they were 3 or 4 years ago. So there's a fair amount of opportunity in China. If you're a stock picker, you can pick the stock that you want. I'm not really an individual stock picker, so I'd like to get in on this index. I mean, I could buy it here. I'd like to buy it a little bit lower if I could, but it looks like there's an opportunity for HSBC thinks it's another 10% before the end of the year. Could be more than that, but there's some opportunity here. The fact that you missed this week, I mean, it was a little tough. Didn't know how big the bazooka was going to be, but this is what is lifting a lot of markets. Base metals, it certainly helped gold. The gold is starting to consolidate. I think it'll help the U.S. markets, and it's actually also helped Bitcoin quite a bit.
Oh yes, yeah. Speaking of which, Bitcoin did soar above that 65,000 level today, and this was even before the PCE data.
Right, and it looks really good because I was concerned about Bitcoin, and I'd shown that chart quite a number of times where it was in a downtrend. We're getting lower highs and lower lows. Well, we've clearly broken that downtrend now, which would be good for Bitcoin bulls. I don't know if we are going to get back up to 73, 74,000 highs that soon, but certainly we're out of the downtrend, and we may be consolidating, and hopefully if we continue to get we will get Fed rate cuts, but if it looks like it's going to be another 50, if the stimulus plan out of China, the fiscal stimulus plan, as it comes to fruition, looks good, you can certainly see that's going to help Bitcoin because it's going to help all other risk assets, and it'll change the mood where instead of selling the pop, you're buying the dip, and that's a mood that's pretty important.
Yeah, and you mentioned that 73,000 level for Bitcoin, which we haven't seen since earlier this year in March, and a technical level that people had been watching for Bitcoin, it was that golden cross, and we do seem to have crossed that today given the advance in the crypto major. So we'll keep an eye on what happens next week and the coming weeks for that cryptocurrency, because year to date it is up by nearly 50%, and that is a considerable gain, right?
It is a great year, don't get me wrong. Just looking at some of the other big ones, Ethereum is up, but still sort of in a in a sideways range, not bringing in a lot of excitement. But the other one, the Solana, is now pushing up against recent highs. So if we can get through the recent highs, Solana might have a little bit more legs under it, a little bit more of a run. But right now it's still mostly Bitcoin focused, as most of the crypto world is Bitcoin is still really the benchmark, by far.
And because it is World Tourism Day, let's move on over to Europe. So Spain and France have been in focus this morning, and this does come after inflation figures came out, and we did see that inflation plunged, fueling expectations that the European Central Bank could also be on track to cut rates eventually.
So the European Central Bank, wasn't expected to cut in October. They were expected to cut in a later meeting this year. I think it might be December. But the inflation data that came out in France and Spain were so bad today. Well, so soft, I should say. It's probably good for consumers. 1.5% in that range for both countries, substantially below where the people were expecting it and where they were the previous month. And it was such a sharp move that an October rate cut was just expected by 25% consensus last week. It's up to 75% in a day. So that's a really big move. And we get some more weak certainly the doves on the ECB will push for a rate cut, and we get some more soft data out of the ECB, out of Europe, the Eurozone. We could certainly see the ECB move a little bit earlier than expected, which will help the dollar a little bit. The dollar's been under pressure, trading at the very bottom of its range, although relatively resilient, that might help the dollar index hold itself up, just because euro is such a big part of that index.
So that is something we'll keep our eyes on, especially as we're seeing central banks around the globe begin their easing. So before we move away from Europe, I do want to say that it's been interesting to see expectations for the Fed Reserve. I know that you mentioned this at the top of the hour, but there are expectations for more cuts from the Federal Reserve, and the bigger cut that we saw last week, there are expectations for a bigger one in November, but we'll have to keep an eye on whether 25 or 50, that balance changes next week.
Right, right. And it's definitely in the mix. So I don't think they have to, the Fed has to call Nick Timiraeus again and say, hey, let's move the market expectations. If it's in the mix, they just don't want to, they don't really want to surprise the markets.
Of course.
I mean, I sort of disagree with that philosophically, because I think the central bank needs to say, we're the central bank, we see more things than you do, we understand more things than you do, and a little surprise, I think, is healthy. You get the market really used to, oh, they'll never surprise us. I think sometimes, from time to time, a surprise is good. I mean, look at what China did. They surprised the market, in a big way, and they got a big impact out of it. I mean, if they slowly let things dribble out, would they have gotten the big bang that they sort of did? Maybe not. So from time to time, I think you want to retain the capacity to surprise.
And speaking of surprises, Tai, it is a U.S. presidential election year, and the countdown is on to November 5th. Hard to believe, but since next month is October, it means we're inching closer to that November 5th date. And here in New York, we have been seeing a lot of delegates from countries around the world, different nation states, and they have been here for Climate Week. So I do want to shift our focus to politics and electric vehicles. So we all know that demand for EVs in this country have been lower, but what has Harris been doing when it comes to this EV push?
So what's pretty interesting is the Biden administration has been pretty aggressive in trying to push the low carbon EVs. And remember, Governor Harris is from California. So they came to California has the strictest emissions it has for a long time, of any state in the country. And they're such a big state that sort of the rules they put in place is typically followed by the major car makers, as well as the rest of the country. And some of the more aggressive things that they want is I think the administration had as a target of half of the cars sold in this country to be EV or non-carbon emitting by 2030, maybe 100 of them by 2040. In fact, California wanted 100% of them by 2035, which for the rest of the country is there's really very little chance of that, because the infrastructure required to produce the charging apparatus for this many cars is going to be very difficult, particularly for trucks. I mean, you've got all these 18-wheelers. We're a very trucking country, getting stuff from city to city. If you had to charge a big semi, I mean, it would take a long time, and you would probably need places that would require the power that would supply a small city. So what's interesting is Vice President Harris is walking that back. No, we don't really want vehicles to be to EV adoption to come that quickly. And she's thinking about the Midwest. She's thinking about Michigan, and it tells you that this is a climate. It's been a big thing for the Democratic Party, that she's walking it back. It tells you how close this election is.
And we know that when it comes to climate as well as EVs, it's a highly political issue, and one that voters across the country are paying attention to. So we'll dive deeper into EVs in the coming weeks, I'm sure, given everything that's happening with the campaign. So Tai, it has been a pleasure this week talking about everything happening around the globe when it comes to markets. So have a great weekend, and thank you so much for all of your
exciting
insights.
Week next week as well.
Indeed. Thank you so much,
Good to be here.
And coming up next, we will be joined by Dan Ha, partner at Karani Asset Management. Don't go away, we'll be right back. Welcome back to Global Money Talk. As we get ready to wrap up the week, the month, and the quarter, Sampro TV is bringing you a Market Insight segment with Dan Ha, partner at Karani Asset Management. Dan, happy Friday. Thank you so much for joining me.
Well, thank you for having me. I was in your seat yesterday.
Yes.
That is not an easy seat to be in. So thanks for having me.
Well, it's great to have you here, and you're in this seat today for
Yes.
our Market Insight.
Yes.
So, since you last joined me, we have seen the Federal Reserve move, and it's hard to believe it does feel like it's been weeks ago, but
Right.
at the conclusion of the September Fed rate meeting, the central bank cut by 50 basis points, and
right.
much better than expected, but not a complete surprise.
Right.
So, since the last time you spoke with us, this has happened, and given the latest economic data releases that have come out, we could get another 50 basis point cut
Sure.
at the Fed meeting. But
Sure.
what do you make of the Fed's move at the conclusion of the September meeting?
Right. So last week's move, the 50 basis point cut, was incrementally positive in my view, and let me explain why. So there are, even though I don't think this is a consensus view, there are some very smart people who believe that we are already in a recession. Like for instance, Jeff Gundlach at Double Line Capital thinks that it's highly probable that we are already in a recession. So let's just suppose that we are in a recession. If we are in a recession, then you probably want the Fed to be cutting aggressively. 50 basis points isn't a supersized move, but it's certainly more aggressive than 25 basis points, right? So if the economy is already in a recession, then the focus should be on trying to bring the economy back on track as quickly as possible. And it's not going to happen overnight, so it'll take time. Fed policies do take time to go into effect into the real economy. So the Fed cutting by more, by 50 basis points, was a good move if we are in a recession. Now, let's say if we're not in a recession, which would then imply that the Fed is not late, that the Fed is not behind, and all the economic data indicates that the economy is slowing, and the inflation is also on track to be where the Fed, where the Fed wants it to be, which means that now probably is a good time for the Fed to start cutting, so that the Fed doesn't stay too tight for too long and pushing the economy into a recession. Therefore, cutting by 50 rather than 25 is probably a better move. So then maybe you achieve a soft landing that way. So. Now, you might think, okay, so it's like 50 basis points was a good move either way, like either scenario, so there's nothing that could have gone wrong. Well, there is a scenario where the 50 basis point cut could be a negative, and that is if inflation reaccelerates, which is not a commonly held view, I don't think. It's not my base case, but it is possible that that the Fed's 50 basis point cut could reignite inflation, and then the Fed would have to start tightening again, and that'll be bad. And like I said, that is not a widely held view, but Mark Twain said, "It ain't what you don't know that gets you into trouble; it's what you know for sure that just ain't so." Therefore, the fact that most people don't expect that to be the case, inflation reaccelerating. If it does happen, emphasis on if, but if it does happen, it'll probably hurt. So that would be the negative scenario, but barring that, the 50 basis point move seems to have been the right move, whether we're currently in a recession or not yet in a recession.
And Dan, I think it's very helpful for the viewing audience for you to walk through these different opinions as well as different scenarios, because as you mentioned, we do not know what's coming down the pike,
Right.
whether or not the economic data releases that are projected or forecasted come in line with estimates. And
Right.
without that crystal ball, we don't know whether or not inflation may go up or down, at least in the long term. And I
Right.
know that you pay attention to what is long-term. So
Yeah.
when we're talking about the trajectory of the Federal Reserve, I think it's healthy and
Yeah.
also helpful for you to talk about popular as well as unpopular opinions.
Right, right. And I should probably bring this chart next time. I didn't bring it today, but DFA, Dimensional Fund Advisors, has produced this chart that demonstrates that even if you knew for sure what the Fed was going to do, what interest rates were going to do, it actually doesn't have that much. It doesn't really predict equity price performance over various different time periods, because equity prices is a multivariable problem. It's not like there is just one variable that is the interest rate that drives equity valuations. So, interest rates matter. It is an important part of the variable, but it's not the only thing. Therefore, even if I knew, and I can't, and I should never I should never know, even if I knew exactly what the Fed was going to do at the next meeting, it still doesn't. I still can't rely on that solely to predict how equity prices are going to move. So, we always have to think about the likely outcomes, but like I said, there are these tail risks that we do have to be thinking about as investors, because, like I said, it's what you know for sure that just ain't so that could really hurt you.
And you mentioned tail risks. So for those in the viewing audience who may not understand what you're referring to, can you explain what that is and how you're managing this?
Right. So tail risk, I'm referring to unlikely events. So in a distribution curve, at the tail end are the low probability events, but it doesn't mean that they can never happen.
Yeah.
It can happen, like black swans. Statistically, should almost never happen, but they happen, right? So you do have to think about, all right, if that were to happen, how am I exposed? And for us right now, like I said, the inflation reacceleration scenario would be a tail risk. And how are we managing that? We're basically avoiding things that have gone up as a result of the Fed rate cut expectations. So what are those? Small caps, real estate, home builders, banks, as well as non-profitable high growth companies, which are long duration assets. And these are things that have performed well with the expectation that the Fed will be cutting rates, because they benefit from lower interest rates. They're more rate sensitive assets. So, as I mentioned a few weeks ago when I was on the show, these are the kinds of scenarios that we're not really interested in. We're not saying that they're not going to go up. That is not our position. But these sort of binary macro based outcomes where, all right, if rates go up, they'll do poorly. If rates go down, they'll do well. It's not something that we're really interested in. So we just avoid these types of areas, except for home builders, which I do think presents an interesting risk reward. But besides that, the other sort of the more binary outcomes, we just stay clear.
Well, Dan, I think it's very helpful when we're talking about investing. There are so many idioms, expressions, and terms. So to understand what tail risks are, it's helpful to visualize, right, a chart and seeing it like this and looking at the potential for these black swan events for minimal probability of these things happening.
Right.
But one thing that you just mentioned right now is the non-profitable tech being a long duration asset. So can you explain this and break it down to our viewers?
Right. So a long duration asset, put simply, means an asset where you'd have to wait a long time, where it would take a long time for you to start getting paid.
Okay.
So if you think about a company that is not profitable today, that is not expected to be profitable at least for the next 5-6 years, you basically have to wait that long before profits begin to show up. Because of the time value of money, we know that dollar today is worth more than dollar 10 years from now, which means that the longer I have to wait as an owner of that asset before I start seeing the profits roll in, the more sensitive that asset is going to be interest rates, which governs the discount rate. So it's important to understand that, because if you want to think about how you're going to be exposed in various interest rate environments, that's something that you have to understand, because you could buy a company that has really got really exciting growth story and is growing really robustly, but is reinvesting so heavily in the business that is not expected to generate a profit for 5, 7, 10 years. When interest rates move, they're going to be really sensitive. So, and it works both ways, right? So during COVID, when interest rates went to zero, that's when you saw a lot of these high growth, no profit technology companies get to really, really premium valuations. Because, like I said, long duration assets are sensitive to interest rates in both directions. But then when the Fed started to increase rates very aggressively, that's when these things really got crushed. And on the other hand, while these things were getting crushed because interest rates were going up, on a relative basis, values, what we typically call classic value stocks, sort of low PE, low growth, but generating a lot of free cash today and next year, those stocks did relatively better, because those stocks are less sensitive to interest rates, and in fact, so on a relative basis, those are more attractive.
Yeah, I think it's so important to be able to break that down in terms of the correlation to interest rates and what happened in different rate environments. So I do want to go back to a comment that you made earlier. You did say that you're looking for other ways to play the market. So we know there's been a lot of volatility this year. We're about to head into the final quarter of this year. But at this moment in time, as we move forward into not just the rest of this year, but next year, what are you looking at?
So if we're avoiding these sort of tail stuff or binary situations, how are we playing the market? So I do want to answer that first by just mentioning that our view on sort of valuation levels right now is fairly neutral. We see that in the bottom-up valuation work that we do very regularly, something that we do all the time. And that work indicates that most of the companies that we follow, valuations seem to be okay. They're not really attractive, and they're not really expensive either. And of course, I'm making a general statement here. There are some exceptions within the companies that we follow, but generally speaking, we see more sort of neutral valuation cases than not. That is also confirmed by, we also utilize outside research. There are some research firms that we trust more than others, and that is also confirmed by the views of these external sources that we use. And I'll also mention that it's also something that Howard Marks of Oaktree Capital said on Monday when I went and interviewed him. So, by the way, that's a teaser. So the my Howard Marks interview is coming to our viewers within the next couple of weeks. So please stay tuned. But yeah, it was also his view. It was also his view that stock prices weren't necessarily cheap, but they weren't necessarily really expensive either. So that's kind of the valuation backdrop, the sort of the stage that I want to first set. Now, and I've said this before, but we are finding more attractive risk-reward opportunities in the larger cap technology space. And let's put these companies through some of these scenarios, right? So let's suppose that we are currently in a recession, like some people argue. If we are in a recession, then I don't want to go down the quality. I don't want to go into a recession with lower quality companies. And by lower quality, I mean, companies with a lot of debt, companies with sort of shaky, higher business development risk, companies with thinner profit margins, if we're in a recession, and if we're going to be in a recession for a little while, I want to go into a recession with debt-free, highly profitable, um, really sort of stable businesses. And a lot of these larger cap software companies, um, they're usually debt-free, have tons of cash on their balance sheet. They're really, really profitable, generating lots of free cash flow, and often they're selling what are essentially modern-day essentials. So if we're in a recession, and valuation levels, it's important to pay attention to valuation levels, because if you find these kinds of companies and if you're paying like really premium valuation, then it's going to defeat the purpose, as I've said on the show before. But provided that the valuation levels are pretty neutral, these are the kinds of businesses that I would want to have if we're going to go into a recession. And by the way, if the tail risk situation happens, and if the Fed needs to raise rates again because inflation reaccelerated, then these are also shorter duration assets than those sort of higher growth, no profit types of companies. You know, they're not going to earn, those companies aren't going to earn profits for a long time. These companies are earning profits, lots of them, today. The third scenario is if the economy is doing perfectly fine, and if the Fed successfully orchestrates a soft landing, and if we're going to have economic prosperity from this point on for multiple years, then you want to be involved with the company that's going to fully participate in that. And so what do I mean by that? You know, I want companies that have really strong base businesses that'll benefit from a broad strengthening of the economy, but also are doing some really exciting things on top of that, so that they have the potential, the optionality, if you will, to do even better than just a broad, than just a broad economy. And you can find a lot of those. Well, a lot of those. You can find those types of companies in the larger cap technology space. You can't just blindly pick anything. You obviously have to do your homework and pay close attention to valuation, but you can find those opportunities.
And Dan, before we move away from this, I do want to ask you about quality. So you mentioned potential scenarios for the economy if we're in a recession, but let's just say there is economic prosperity, at least for the foreseeable future, even with tail risk. Does quality matter not as much in that case?
That's a good point. In the sort of more near short to medium term, my guess is that it won't matter as much. What I mean by that is, all right, so in a broad economic prosperity kind of scenario, a lot of these companies that have been performing well recently because of the Fed, the expectation of Fed cuts and such, they've largely been laggards over the past, year to date, and over the past year, year and 3 years, relative to their larger peers. So if we're in an environment where everyone, broadly speaking, is supposed to do well, these companies the stocks do have some catching up to do, and therefore they will more likely than not outperform their larger cap counterparts. Also, if you think about it, like small caps, again, I want to make it very clear, I'm not predicting that small caps won't do well. The argument for small caps is that when rates are lower, not only are the stocks benefiting because of the long duration nature of the asset class, but a lot of these smaller cap companies are they're more indebted than the larger cap counterparts. Not in terms of the absolute dollar amount of debt, but just in terms of there are more smaller companies that have debt than the larger companies. A lot of them have floating rate debt. Therefore, if rates are going down, that's going to be good for their bottom line because their interest payment is going to be less. Therefore, if we have a scenario where economy is doing well, rates are gradually going down, that's a scenario under which these stocks will probably outperform the larger cap counterparts. But in the really long term, it is our philosophy, it is our view that long-term investors ought to have sort of a quality bias. Because at the end of the day, over a very long-term period, and I've mentioned I referred to the Dimensional Fund Advisors work about interest rates not really having that big of an effect. Over a very long term, what's really going to drive stock price performance is earnings growth. And how do you get earnings growth? A company that is growing well in the top line, the company that is able to protect their, protect their margins as they grow. That's how you get earnings growth. And over the really long term, stock price follows earnings growth. So I think quality always matters to a long-term investor. But if you want to play more of a sort of put on a short-term trade based on your view of where the economy is headed or where the interest rates are headed, then you could use things like small caps and more rate-sensitive asset classes to play that. It's just not something that we do.
Well, I think it's great that you broke it down for us, because the narrative that we had been hearing in the middle of the third quarter, especially ahead of the volatility we saw on August 5th, that we were starting to see this rotation into small caps away from the Mag 7 names. So I think that's very helpful. And I think this is a great time to do a market check, because the Russell 2000 in New York morning trade is outperforming the major equity averages. It is higher by 1.5%, but the Dow Jones Industrial Average is rallying this morning as well, up by 1% or 420 points. Meanwhile, the Nasdaq is lower on the session, is down by 0.2%, and we are seeing the S&P 500 maintain gains on the heels of the record highs yesterday. But since, Dan, we're talking about some of the AI names, it's very interesting. We know that when we're looking at some of the Mag 7 names, their PE ratios are not necessarily low. But you said earlier that there are companies that are doing exciting things. So what kinds of things did you have in mind?
Sure. I mean, for in the technology space, the most exciting thing, obviously, is AI. Now, I do want to be clear, like AI could be a fad, right? We don't know, nobody knows how AI is going to play out, but there are a lot of indications that point to AI being potentially really promising. I don't think I need to remind that to our viewers. I think everybody knows, right? That's also why it could potentially be dangerous, because it's something that everybody knows. Having said that, though, when you take comments like, so Elon Musk was at a conference a couple of weeks back and said something like, not an exact quote, but something like, AI he's never seen another technology platform that is advancing as quickly as AI. And then you take somebody like Sergey Brin, the co-founder of Google, who was also at the same conference. He said that he is spending these days all of his time on working on AI, because as a computer scientist, it is the most exciting thing that he has ever seen. This is coming from a man who co-founded Google, right? So you could they're really at the forefront, and you could take their words at face value. I mean, Jensen Huang, at the forefront of all of this. He's really excited about it. Now, they could be wrong, right? So just because you're at the forefront doesn't mean you're always right. But you do have to think about, well, who's closer to the action here? And you don't always have to be the closest to the action to know the truth. So for instance, if we're talking about a really well-established, developed industry like chemicals, for instance, or oil and gas, you could be an outsider, not at the forefront of some chemical manufacturing technology, and know what is possible and not possible in the world of chemicals or in the world of oil and gas. But we're talking about something that is brand new, that has never been done before. And in a world, and when we're talking about something that is brand new, you do have to wonder, well, who's closer to truth?
Yeah.
Those that are really deep in the weeds and are at the forefront, or those who are kind of observing from afar and from the outside, if you will, and saying, I don't think that's going to be possible. So you do have to, that's something that we think about all the time as as investors, who's closer to the truth and who do we want to believe? And when we look at AI, I'll share some stories. Amazon CEO Andy Jassy last month talked about how Amazon's Gen AI tool to help their Gen AI assistant for their software developers has saved the company 4,500 developer years by using that assistant.
That is considerable.
It's not 4,500 developer hours. It's 4,500 developer years. Like, can you imagine that? That's that's a very long time.
That could be a lifetime.
Right. Well, like many generations.
Yes.
Right. Not only that, on top of that, they're also, according to Andy Jassy, so far has had something like $260 million worth of annualized worth of savings that come from efficiency gains by using this Gen AI assistant. Like, those are real dollars, and for 4,500 developer years is really tangible. And it's not even just tech companies. Like Walmart CEO recently, I think it was on the conference call, talked about how because they use AI, they were able to reorganize or redo their catalog with 850 million data points. If they had not used AI, it would have required 100x headcount to do the same amount of work, probably in the same amount of time. So those are real tangible benefits that we're talking about. So, and actually, this past Monday, we showed a video of the AI dubbed what was originally a Korean interview that was dubbed using AI, and because AI was used, it took something like 1/5 the time that it would have taken a human to do the same kind of work, and 90% of the work was done by AI, and only 10% had to be human touch. So these are real tangible benefits. So whenever I hear sort of the bearish argument, which often is sort of around, well, AI really, there isn't real great value-adding use cases right now. All it can do is just summarize text and maybe help developers write some code. I'm like, $260 million and 4,500 developer years doesn't sound like developing, helping some software developer write some code. And it certainly seems like it'll be able to do way more than just summarizing text. But there are both sides to the argument, but I do think the bullish case, quite frankly, is more, at this point, more credible.
And you speak to the tangible benefits, not just in technology, but across different industries.
Right.
And we hear about the use cases, the application of Gen AI and what it means to humanity. But if we are able to focus on the more important tasks, you brought up the example of the video that was dubbed, and I personally was amazed by the quality, especially when it comes to language. We think about all the expressions, the idioms, especially when we're talking about something technical like finance and economics. And it was quite astounding to see the end result and the product as well.
Right. It was pretty mind-boggling. Yeah.
It was. And you did mention the bearish case, so now that you've set up the case for this, tell us what your opinion is.
Yeah. No, sure. I mean, obviously there is a base case, bear case, and the bear case usually goes something like this. You can basically take all the work that is being done by humans today, and people try to think about, well, what % of that work can be replaced by AI? and then you can quantify, well, okay, if all these companies can replace that work with AI, then how much savings is that going to be for all the companies? And compare that to how many dollars are going in today to support the development of these AI capabilities. And when the number is unfavorable, then AI is overvalued. Is essentially is essentially the bearish argument. The only problem with that argument, I think, I mean, well, not only, but the biggest problem with that argument is assuming that AI the capabilities won't become dramatically better within some reasonable time frame. It's hard for us to, generally speaking, imagine what is capable of when it comes to things that we just have never had before, right? Jensen Huang actually at the conference that I mentioned last week when I was here, at that conference asked the audience. He said, if airplanes were 1 million times faster, what would you do differently? It's kind of hard for us to imagine. We're only limited to what we've experienced thus far. It's really hard to imagine something that we haven't experienced yet. But so, it is possible that it could really change a lot of things. And it's just really hard to imagine. So sometimes it's helpful for me to think about, like, if I were to short NVIDIA or AI as a theme, then I would I'd have to ask myself a question: what is my risk? What if all these things actually happen? Then my risk is like totally unlimited. So, that's how one needs to weigh sort of the risk reward of any theme or any investment proposition.
And Dan, I personally have never thought about what would it mean, the implications if airplanes could go that much faster.
Right.
So perhaps that is how we should be thinking about artificial intelligence, or at least for a plot of a movie.
Right. If you're trying to think about the bullish case in the risk-reward equation of AI, then yes, you do want to use your imagination.
Okay, Dan, well, it's such a fruitful conversation on AI and where we stand right now in terms of investing. So thank you so much for joining me today.
Pleasure.
And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We will be back on Monday, so have a great weekend and have a great day.